I once worked with a group that spent 18 months trying to raise $25 million from individual investors, folks like doctors, lawyers, and successful business owners. People who absolutely had the money, but treated every single meeting like a dissertation defense. Every single detail got dissected, every assumption got questioned, and every projection got stress tested to death. But something interesting happened. When they stopped chasing individual investors and shifted their focus to institutional capital, that same group raised $75 million in just 8 months. And I've personally raised over $1 billion across my career, working with everyone from non-accredited investors all the way up to sovereign wealth funds. And I can tell you this with complete certainty. The difference between raising money from regular people and raising from billion-dollar institutions is staggering. So pay close attention, because once you see this distinction, it will permanently change how you think about raising capital. Here's what most people do and where most people get confused. They assume that if an investor says no, then the pitch must be bad. What I've seen over and over again is that the exact same presentation can fail repeatedly with individual investors, but get immediate traction with institutions. And it's not because institutions are less sophisticated or less discerning than individuals. It's because they're evaluating something completely different. When you sit down with a typical individual investor, they're looking at the deal itself. They want to know, is this the right location? Do these cash flow projections feel conservative enough? Would I personally feel comfortable owning this asset? They're filtering everything through their own emotional risk tolerance, and they're asking themselves, would I sleep well at night if I wrote this check? Let's compare that to how billionaire level or institutional investors think. They're not obsessed over whether one deal is perfect. Instead, they are focused on you, your track record, your systems, your decision-making process, and your ability to execute consistently and ethically over time. They're asking a much bigger question, which is, can this operator professionally manage capital across multiple opportunities? And that single difference explains why you can pitch the same deck 20 times to retail investors and hear nothing, but show it once to the right institution and move straight into due diligence. But now, let's talk about something that surprises almost everyone, which has to do with the speed of money. Because most people, they think that the bigger the money, the slower than it moves. But in reality, it's actually often the opposite. Wealthy individuals, they can stay on decisions forever because there's really no pressure on them. It's their personal capital, and they'll deploy it whenever they feel like it. And I've seen doctors take months to decide on a $250,000 investment, or sometimes even smaller than that. Institutions, on the other hand, they don't have those same luxuries. You see, they operate on quarterly mandates, and they have both allocation targets and deployment deadlines. And I've personally seen institutions with a $100 million mandate move faster than individuals writing checks that are a fraction of that size. Here's the part that most people misunderstand. The committee structure, it doesn't slow things down. It actually speeds decisions up, believe it or not, because there's a defined and systematic process. And if you don't fit their box, then you'll typically get a very fast no. But if you do, then they will lean in quickly and start to dive deep with you very fast. And once you understand this, everything shifts. You stop trying to sell institutions, and instead you position yourself as someone who can solve their deployment problem. And that's why, counterintuitively, when conditions are right, bigger money often moves faster than smaller money. And this leads us to the third piece, which almost nobody is taught, and that is access. Getting in front of wealthy individuals often requires personal relationships, things like warm introductions, social proof inside of their circles, or years of network building. But institutional capital works differently. They actually expect deal flow from operators that they've never met before, and they try to keep a pulse on what's in the market. So they have formal intake channels, standardized screening processes, and defined criteria for evaluating new managers. So your lack of connections matters far less than people actually think. And in fact, legal frameworks like 506C actually make institutional capital more accessible because you're allowed to actively solicit and market them even without a pre-existing relationship. And that's why you sometimes see operators with no personal network whatsoever suddenly accessing institutional money faster than what it would take for them to build an individual investor list. They're simply playing the right game. And this is usually the moment where people realize why they've been unnecessarily stuck. But truthfully, most people never see this distinction. And that's why they keep chasing the wrong investors while the real money sits there just waiting for someone who understands how the system actually works. Now, if you want to learn the exact frameworks that I use to position operators for either institutional capital or wealthy investors, I'm offering free strategy calls where I break down the entire approach step by step. You'll find the link below this video. So here's the big takeaway. The difference between raising money from wealthy individuals versus institutions isn't just the amount of money that they can offer. It's that you must operate using two completely different business models. One requires selling individual deals to people, and the other requires demonstrating systems to professionals. And understanding this distinction is what allowed me and the operators that I work with to dramatically compress fundraising timelines and scale deal size significantly. And the best part is that this transition process isn't some sort of secret mystery. It's systematic, it's repeatable, and it's learnable. So while everyone else out there is still trying to convince their rich uncle to invest in their deals, you now understand why institutional money is often the easier path. So if you want me to personally work with you through the exact structures, positioning, and processes that you can get wealthy individuals or institutional investors to say yes, then book a free strategy call using the link below. This is the same system that took the group that I mentioned earlier from 18 months of rejection to 8 months of success. And I'll show you how it can apply in your business. Because these principles, they work whether you're buying real estate, acquiring businesses, or scaling any serious investment operation. And if you want to see how this institutional approach applies to building an entire fund structure, then watch this next video on your screen, which shows you how to start a real estate fund from scratch.